It's February 26, 2022. Sergei Alexashenko, former deputy governor of Russia's central bank, is watching his country get cut off from the global financial system in real time. The G7 has just agreed to freeze approximately $300 billion in Russian state reserves, half of everything Russia's central bank had spent decades accumulating, locked overnight in Western clearinghouses. Alexashenko called it publicly that day a financial nuclear bomb falling on Russia. Western economists agreed. Investment banks forecast GDP could fall 15% or more. A Yale research team predicted Russia's economy would implode within months. 2 years later, the IMF revised Russia's growth forecast upward twice. Russia's GDP grew 3.6% in 2023, then 4.1% in 2024. It outperformed Germany, France, and the United Kingdom. The bomb had detonated. Russia adapted around the crater. Here's why this matters to you. The logic behind those sanctions, that financial interdependence creates leverage, that removing a country from the dollar system is decisive, is the same logic embedded in how Western banks, pension funds, and energy markets manage systemic risk today. When that logic is wrong, the costs don't stay in Moscow, they distribute. Today, we're going to trace exactly how the most expensive sanctions regime in modern history worked, why it failed to do what it promised, and what the mechanics reveal about the financial architecture the rest of us live inside. To understand why Western policymakers were confident, you have to understand what they thought they were threatening. In 2021, Russia's economy was deeply stitched into the Western financial system. The Central Bank of Russia, led by Governor Elvira Nabiullina, a figure that Harvard-trained Western economists had praised for her steady monetary management, had built foreign exchange reserves of approximately $630 billion. Russia supplied around 40% of the EU's natural gas, according to Eurostat figures. BP, Britain's largest energy company, held a 20% stake in Russia's state oil company Rosneft, worth billions. IKEA ran 26 Russian stores. McDonald's operated 850 restaurants. The image was of deep integration. The assumption was that integration created leverage. Two warning signs were sitting in plain view. First, after Russia's 2014 annexation of Crimea triggered an earlier sanctions round, Moscow spent the following 8 years systematically reducing its external vulnerability, cutting government debt, building reserves, and expanding import substitution. The 2014 sanctions were a rehearsal. Second, by early 2022, the US dollar share of Russia's reserve basket had already dropped from 46% in 2017 to just 16%. Russia had been quietly diversifying away from dollar dependency for years. Neither signal triggered any public policy response from G7 governments. Think of it like a building owner who's been quietly fireproofing every floor for a decade while the inspectors keep ticking the safe box. Russia wasn't surprised by the bomb. It had been building the shelter. But here's where the story quietly starts to break. On February 26, 2022, finance ministers from the US, EU, UK, Canada, Japan, and Australia agreed to freeze Russian central bank assets held in their jurisdictions, approximately $300 billion, with roughly $200 billion sitting in Euroclear, the Belgian securities clearinghouse. U.S. Treasury Secretary Yellen called it a crippling blow to Russia's ability to stabilize its currency. On the Moscow exchange, the ruble fell 30% in a week. Let's run the math on this. $300 billion is more than twice the UK's annual NHS budget. It was money Russia had spent 30 years accumulating. As of mid-2026, most of it remains frozen, the subject of ongoing legal disputes about whether Western governments can legally spend it or must merely hold it. Russia didn't get the money back. It didn't collapse either. On February 28, 2022, Elvira Nabiullina raised Russia's interest rate from 9.5% to 20% overnight. She simultaneously imposed capital controls, requiring Russian exporters to convert 80% of their foreign currency earnings into rubles, flooding the domestic market with forced ruble demand. By April 2022, the ruble had recovered to its pre-war exchange rate. Here's what nobody in that room was saying out loud. Western analysts had modeled ruble collapse as the mechanism through which sanctions would produce political pain. When the ruble stabilized, the mechanism broke. This is the moment the crack became a fault line. The West had assumed Russia had no room to maneuver. Nabiullina, a trained economist operating inside an authoritarian government, demonstrated that shock absorption looks very different when capital controls are an option. Between February and October 2022, ruble-yuan trade on the Moscow exchange grew 80-fold. By early 2023, the yuan had surpassed the dollar as the most traded foreign currency in Russia. Russia-China bilateral trade jumped 29% in 2022 to $190 billion, then a further 26% in 2023 to $240 billion, per China's General Administration of Customs. By December 2024, Vladimir Putin announced that approximately 90% of Russia-China transactions were settled in yuan or rubles, no SWIFT required. China and India and Turkey had not signed on to the sanctions. They were not violating them. They were simply doing business with a country that needed customers. The G7 had designed a punishment using tools that roughly 1/3 of global GDP had no obligation to honor. In December 2022, the G7 introduced a $60 per barrel crude cap on Russia. Clever in design, intended to limit Kremlin revenue while keeping oil flowing to prevent a global supply shock. Russia built around it in under 2 years. The mechanism was a shadow fleet. The Kiev School of Economics estimates Russia assembled over 400 tankers, aging vessels registered under flags of convenience in countries like Gabon and Palau, transporting oil outside the reach of Western insurance and shipping services, and therefore outside the cap's jurisdiction. By 2024, China, India, and Turkey were absorbing roughly 80% of Russian crude exports. The shadow fleet generated approximately $9.4 billion in additional revenue for Russia in 2024 alone, according to KSE calculations. Russia's oil revenues actually increased roughly 5% that year compared to 2023. Pause here for a second. If you're starting to recognize this pattern from somewhere else, a rule imposed, infrastructure assembled to root around it, third parties profit from the gap, you're already ahead of where this story ends. Stay with me. Here is the central paradox, and it needs to be stated precisely. Russia's GDP grew, but what grew it was military spending. According to SIPRI data, Russia's defense budget rose from 2.7% of GDP in 2021 to 7.1% in 2024, from roughly $65 billion to an estimated $140 billion annually. Defense now accounts for approximately 35% of Russian federal expenditure. Every ruble spent on ammunition and soldier wages registers as GDP. That spending tightened the labor market and pushed real wages up 7.3% in 2024, numbers not seen in almost 2 decades, according to CSIS research. Is that a healthy economy? No. According to modeling published in Economics Observatory in February 2026, citing IMF analysis, Russia's GDP is now approximately 10 to 12% below where it would have been absent the invasion, a real and significant cost. That gap is the sanctions working. It just didn't work the way anyone announced it would. Russia avoided the West's trap. It walked into a different one. By pivoting so rapidly toward China, Moscow ceded leverage it had spent decades building. Reports cited by the Atlantic Council indicated Russia was selling gold to China at discounts of up to 30%. The yuan is not freely convertible. Beijing controls its value, meaning Russia cannot freely liquidate yuan-denominated assets without Chinese approval. In March 2022, the Russian Central Bank and National Wealth Fund held an estimated $140 billion in yuan-denominated assets that Beijing could, in theory, restrict. Putin himself acknowledged in December 2024 that payment settlements were the primary challenge in Russia-China trade. That's a diplomatic phrase for structural dependency on a partner whose interests are not identical to yours.
The fundamental miscalculation was an assumption with a long record of failure that economic pain translates to political behavior change in authoritarian, commodity-exporting states. It did not work in Cuba over 60 years. It has not worked in Iran or North Korea. What sanctions reliably do is signal. They tell domestic audiences that governments are responding. They impose genuine friction, and they make a moral statement. What they do not reliably do is change strategic decisions in governments whose calculus differs from Western democratic norms. Russia had a resource base, a large non-sanctioning neighbor, and a leadership willing to transfer economic pain onto its own population. The sanctions were designed for a system that operated differently.
The inflection point came in June 2024. The U.S. Treasury sanctioned the Moscow exchange itself, the last major venue where Russia officially traded foreign currencies. The yuan's share of Moscow exchange foreign currency trading went from 54% to effectively 99.8% within weeks.
This was framed as tightening the noose. It completed Russia's financial decoupling from the West, a transition Russian policymakers had been working toward for a decade. The exchange had already built the infrastructure to function without dollars and euros. The sanction accelerated a transition Russia wanted anyway.
By late 2024, Nabiullina had raised interest rates to 21% to contain inflation running above 9%, evidence of genuine economic stress. Russia's businesses faced severe pressure. Bankruptcies were rising, according to Economics Observatory analysis. The war machine kept running. Russia's 2025 defense budget was estimated at 7.2% of GDP, according to SIPRI, a real terms increase of 3.4% over 2024. That's approximately $145 billion dedicated to a military that sanctions were supposed to defund.
Now, before you file this under Eastern European Geopolitics from 4 years ago, two mechanisms are worth watching from wherever you're sitting.
The assumption that financial interdependence creates leverage underpins how U.S. regional banks are currently managing commercial real estate exposure, a sector under structural pressure as remote work reshapes demand. The assumption is that interconnection limits downside. The Russia case suggests interconnection is a network that can be rerouted. Leverage only exists if the other party can't exit.
The U.S. dollar's role as the default global reserve currency is a network effect, not a law. Russia didn't choose to de-dollarize. It was pushed, and then other economies watched and updated their models. The IMF's COFR data shows the dollar's share of global central bank reserves declined from roughly 71% in 1999 to around 58% by 2024. The Russia sanctions provided a live test of alternative infrastructure. Other governments noted the results.
One thing worth monitoring, whether Gulf state oil exporters begin settling contracts in yuan at scale. The infrastructure now exists. It hasn't happened in volume yet. This isn't a history lesson. It's a pattern recognition exercise.
Sanctions are an effective signaling tool and impose genuine economic friction. They are not a reliable behavior modification tool against authoritarian commodity exporters with large non-sanctioning neighbors. The structural flaw, the architecture was designed by countries that assumed everyone needs access to the Western financial system to function. Russia found the emergency exit. It has since been widened for others to observe. Western policymakers committed a named cognitive error, mirror imaging, projecting their own system's incentive logic onto a different system. When economists modeled ruble collapse as politically decisive, they were modeling Western financial psychology applied to Kremlin decision-making. Putin and Nabiullina treated economic pain as a cost of the mission, not as a reason to abandon it. Diagnosing this error isn't a condemnation. It's a repeatable, predictable human failure that will happen again in the next sanctions episode, unless the model is updated. The global financial plumbing, SWIFT, dollar clearing, Western insurance markets, is more political and more fragile than it appears from outside.
If you manage a portfolio, run a business with international supply chains, or work in any sector exposed to commodity prices, scenario plan for a world where dollar-denominated infrastructure is one of several competing systems, not the only one. That world is already partly built. The Russia sanctions didn't create it, they accelerated it.
Here is the genuinely unresolved question. Was the Western sanctions regime a rational policy response inside a broken international system where no better option existed? Or was it a case of institutions optimizing for the appearance of action over the probability of effectiveness? That question matters because the same instruments will be reached for the next time a major power does something that demands a visible response. Next up, the Iranian sanctions model, the 40-year case study that Russia was apparently reading more carefully than Washington was.
Was Elvira Nabiullina a central banker doing her job under impossible circumstances, or the person whose competence extended Putin's war by years? The argument is genuinely more complicated than it looks. Make your case in the comments. I'll reply to the best ones. If this kind of forensic breakdown is what you're here for, there's more coming. Subscribe, like, share, comment now.